Well, how do you qualify for more mortgage loans at the lowest interest rate available? Americans have near record equity levels in their homes. What's the best way to access that equity, yet keep your low mortgage rate in place? And what about your student loan debt and how that factors into you getting a mortgage or getting a refinance? We're answering all that today with a GRE regular guest. And though it's her first appearance back on the show this year, it's the return of the company president that's created more financial freedom through real estate than any other lender in the entire nation, Ridge Lending Group. It's time for a big welcome back to Caeli Ridge.
Keith Weinhold, thank you. You flatter me, sir. I appreciate it. Love being here with you and for your listeners.
Well, yes, the president is back, and everyone loves this type of president because it's not about being a Democrat or Republican. So, hail to the chief. Great to have you here. And, Caeli, mortgage rates, they have settled down a good bit from their recent highs. Now, they peaked back in the fall of last year. So, with that and some of the other things in mind, why don't you talk to us about the big picture first, sort of your mortgage market overview?
Well, let's interest rates is always top of mind for everybody. I think they're doing pretty well. I do believe I've been sharing with our listeners and my clients on a day-to-day. I do believe that rates will continue to kind of increase here and there. There's going to be some ups and downs, of course. The Fed has been very clear with us that he's going to continue, Jerome Powell is going to continue to raise the Fed fund rate. Just for anybody that doesn't know, the two between a mortgage rate and a Fed fund rate, while connected, not the same thing. So when they raise that, does not automatically mean that we see the increase on the 30-year mortgage bonds. So I think that that's going to continue to happen, but I think the pace in which it happens or continues to happen is going to be a lot less aggressive. So I think that's going to bode well overall for interest rates. I know everybody is very, very interested in are they going up? Are they going down? When are they going up? When are they going down? I think that we'll continue to see a little bit of upward movement. I think it's going to be sometime next year that we start to see interest rates come back down in any meaningful way. And remember, gang, rates go up much, much faster than they come back down, unfortunately. So I think we've got a little bit of way to go. But I'm always the one saying, Keith, you and I have talked about this many, many times. You must be doing the math. And that the rate as a function of the return of the investment isn't the most important thing. So I'll leave it there for rates. Otherwise, I think that the industry is doing really, really well. One big announcement that we had this year was that Fannie and Freddie both have extended the seasoning period of time to where a cash out refinance when leverage was used to acquire is applicable. So now you have to wait 12 months to pull cash out of a property using the ARV, that after repair value, if you use leverage to acquire the property. Quick distinction, because this has been confused. If you paid cash for the property, your source and season funds, that still falls under what's called the delayed cash out refi, and no seasoning is required. It's only when leverage was used to acquire the property, and then they're trying to use an after repair value to pull cash out in hand, is that 12-month seasoning. Rate and term is different, so that doesn't apply either.
Okay, so if you make a purchase and then say less than 12 months down the road, you want to do a refi but not pull cash out, is that still all right?
That's absolutely fine. No seasoning is required, and we can use the ARV. It's only when you want cash in your hand that 12 months is applicable.
Got it. Okay, that's really helpful to know. Just big picture before we winnow down, are there any other big substantial mortgage stories out there that some should know about? It was only a couple weeks ago. There was a lot of misinformation going around on TikTok and elsewhere about 40-year loans from FHA without people understanding that's just for loan modifications and really other stories like that. Any other big picture things where you can help us see what's happening?
It seems to be par for the course. I have not, there's nothing that's come across my desk that I would say was newsworthy or noteworthy to share. I think we've got more to unpack here than any of that.
Yeah, and things sure are picking up here around GRE. People want to buy more properties this year. It really slowed down toward the end of last year, right about when mortgage rates were at their peak. So when we talk about getting loans, we think about leverage. Leverage is created with debt. Has anything changed with the down payment requirements for an income property? And we're largely here in today's discussion talking about 1 to 4 unit income properties, properties that you don't live in yourself.
Correct. Down payments have remained the same. There hasn't been anything that has changed there. Just to reiterate for those that may not be aware, on a single family residence, conventionally, 85% loan to value is applicable. You can leverage all the way up to 85. You're putting 15% down. Keep in mind, everybody, that will have PMI, private mortgage insurance, attached to it. But I would I would have you look at them side by side. The PMI factor is actually pretty low, and depending on the loan size, it may only be 20, 30 bucks a month. So if you're able to leverage extra, it may make sense. You're going to have to look at the numbers. So that's single family, and then 2 to 4 unit on a purchase transaction, different on a refinance transaction, but purchase is 25% down or 75% leverage is required for those duplex, triplex, fourplexes.
Okay, so as little as 15% down on a rental single family home. So you're getting up to 6 to 1, 7 to 1 leverage in that case. Sheila, do you find very many people doing that, or would they rather pay the 20% down for a rental single family home and not have the PMI?
I find that right now, I think that it's less common than maybe it was because interest rates are up from where they were a year and a half ago. So more often than not, we see the 20% down, but I still think it's worth looking at. I mean, you're never going to know unless you run the numbers, right? Side by side.
Okay, so we're thinking about how much cash we have to have put aside for a down payment and closing costs. And one thing that we need to do in order to qualify for that loan in the first place, of course, is some people get hung up on the DTI. Their debt to income ratio is too high to qualify for property. And Caeli, over the past few months, I've had a few listeners write in with questions, and I thought, well, I'll save that question until we have Caeli on again. And one of them really has to do with student loan debt. Student loan debt often contributes to one having too high of a debt to income ratio so that they didn't have to repay their loan. I know that Biden said that you wouldn't have to pay back student loan debt for a while, but can you talk to us specifically about student loan debt with DTI?
Yeah, there's going to be a few pieces to share with everybody, depending on whether we're talking about Fannie Mae or Freddie Mac, and we won't know who we're going to end up selling to after the loan funds. And they have slightly different guidelines between the two of them, similar, but there are some differences as it relates to student loan debt, regardless of whether you're in deferment or you've been told that you don't have to repay. If it shows up on an individual's credit report, the calculation will be as follows. They're going to take the outstanding balance times 1%. That's Fannie Mae's rule, or the outstanding balance times 0.5%. That's Freddie Mac's rule. And that will be the payment that we include in the debt to income ratio. I'll mention that the all-in-one, which is a very popular loan right now, first lien HELOC, maybe we'll talk about that here today, they will defer to Fannie rules. So it'll be 1% of the outstanding debt pulling on the credit report, even if it shows a zero payment listed. Now, there's one caveat. If the individual has a letter, this happened maybe in the last 6 months, and I'm trying to think about, there was a title. It's pretty rare, but if they're able to gain access to documentation that specifies that they are not going to have to repay that debt, and we can take that documentation, then we can zero out that payment in the DTI.
All right, there's some strategies for how you can approach DTI with respect to any student loan debt that you have. And what is the maximum DTI that a borrower can have?
Conventionally and non-QM, you're going to get to 50% debt to income ratio. For the all-in-one, since we just touched on it, 43% is the absolute max.
Okay, and on prior shows, Caeli and I have discussed specifically with examples just how that DTI is calculated. If you're wondering, you can hear that in some past episodes. And, Caeli, when one goes ahead and they continue to add income properties to their portfolio, often I recommend that one does that with high leverage, but not over leverage. How does one keep their DTI ratio down over time as they continue to add properties so that they can qualify for more properties in the future? Is there a good strategy for that?
There is, and it's such a good question because as investors, right, our qualification primers are not static. They're going to change over time as we buy
Yeah.
and sell and refinance. So it's very, very important, especially with the debt to income ratio, that we're keeping an eye on it. And there's a few ways in which you can kind of strategize or optimize that DTI. The first is going to be the Schedule E. Okay, the Schedule E is where all the rental properties are going to live once you've filed the annual tax return. The easiest way for the time that we have here today, Keith, is going to be to tell the listeners, send us your draft returns. So on an ongoing basis, we tell our active clients, do not file federal tax returns until you send us the draft. We're going to run that draft through the pre-formulated calculation that comes straight from Fannie Freddie, and then we're going to provide you with some feedback, one of which may be, Mr. Jones, you forgot to include your insurance as a deduction, and that's actually an add back. That's going to be to your disadvantage. Make sure that you put that in there. You didn't claim the full number of days of income for the property. You forgot to put depreciation on there. That's also an add back. There's a whole slew of things that we can look at and look for and give the individual that feedback so that they are filing at that optimal way while maintaining what the maximized tax credits are, right? There's a nice balance there. The more aggressive you are with the tax deductions, the more it can impact the DTI. So we want to have eyes on that and work closely with the client and or their CPA is a very common part of what we do. So Schedule E, a little more complicated. That would be one of the ways in which we want to maximize debt to income ratio. Obviously not obtaining new debt, new consumer debt is not going to be to our advantage, right? We don't want more liability than we have income. Another thing is that when we talk about credit, okay, and a lot of clients that we talk to, they pay their credit cards off monthly, right? Maybe they charge up $5,000, $8,000, $10,000, they get all the miles or whatever it is. It's very important to communicate with us to find out when in the month we want to strategically pull the credit. Because what will happen is that the day in which we take that snapshot, if there's a minimum payment due, a balance with a minimum payment, that minimum payment will be used in the individual's debt to income ratio, regardless of whether they're going to pay it off at the end of the month. That doesn't matter to us. There's a payment here, we got to hit you for it. So strategizing on the day in which we want to run credit might be another helpful way for DTI. And then finally, and there's probably a few other things, but I think high use would be, I don't like the shorter term amortizations. I think this is something else you and I have talked about many times, Keith, where people want to pay off quicker, which is great. If that's really what they want to do, that's perfectly fine. I'm not sure that that would be my strategy, but whatever. Don't get yourself into a 15-year fixed mortgage because it's only going to jack that payment. It's going to really increase that payment. It's ultimately going to, for long-term optimization, hurt your DTI. You can do the same thing with a 30-year mortgage and not pay extra interest by accelerating the debt if that's what you chose. So those would be the few things I'd comment on.
100%. And for you, the listener and viewer right now, with what you just heard from Caeli, you can begin to understand the value of working with a lender that works specific with income property investors rather than those lenders that are more geared toward primary residence borrowers. Nothing wrong with them, but they're in their lane doing their thing. And you can understand why Caeli over there at Ridge is really a specialist to help you qualifying for as many income property loans as you possibly can and optimizing those loans as well. And Caeli, when we talk about interest rates, oftentimes it's of interest to people to look at what are refinance interest rates like versus new purchase interest rates.
I would say on average, there's a variety of variables that dictate what the rate is going to be. Okay, I talk about this a lot. They're called LLPAs, loan level price adjustments. And a loan level price adjustment is a positive or negative number that attaches to the characteristic of the loan transaction. So purchase or refi, cash out refi, rate and term refi. Credit score has its own LLPA, loan to value, loan size, occupancy, all of these come with a positive or negative number attached to them. As it relates to purchase versus refinance, generally speaking, let's take a rate and term refi where you're not getting cash out, you're just maybe taking an ARM and making it a fixed, you're taking a higher rate and making it lower, whatever, maybe about a 0.5 point difference. So if a purchase was at 6.5, the rate and term refinance might be at 6.75 or 7%. Cash out's going to be a little bit different. I would add a 0.25 point to that. And then if it's a 2 to 4 unit, add another 0.25 point on top of that. So those variables do make a difference.
Okay. And maybe the listener and viewer might think, well, why are you talking about refinancing at a time like this? If I wanted to refinance, I would have been more likely to do that about 2 years ago when mortgage rates were at historic lows. But today, Americans are sitting on near record equity. Oftentimes, it might be tied up in a low mortgage rate loan with that equity. But, Caeli, I talked to some people out there, just lay people that aren't even investors, and they have a big equity position with a really low mortgage interest rate loan. And they seem to think that to refinance it, they would need to go ahead and refinance their entire mortgage and lose that maybe 3 or 4% loan. But they don't necessarily have to if they can do a second mortgage. So I guess really what I'm getting at in the question, Caeli, is what is the best way to do a rate and term refi versus a cash out refi? And I know there are a lot of scenarios there.
Yeah, lots of scenarios. So to your point, it is not necessary to give up a very low fixed rate mortgage if you want to harvest some of that equity. The ways in which, and I'm going to have a plug after this for the all-in-one, but I'll get to that because I'm just such a big fan. But the ways in which you can do that both for your primary residence, a second home, and an investment will be through a second lien mortgage, whether it be a HELOC, loan equity line, home equity line of credit, or a HELoan, The HE loan is applicable for the rental properties. I do not believe. I hope somebody can give me alternative information, but I do not believe you're able to find second lien HELOCs for rentals today. I feel like those have really dried up. If they're out there, the ones that I know of that used to do them are not doing them anymore. If they're out there and anyone's listening to this, somebody please let me know. HELOC for rental, probably not an option. HE loan for rental absolutely is an option. And this is, guys, a fixed rate mortgage in second lien position. Just like your 30-year fixed first, this will be a 30-year fixed second. Interest rates are going to be higher. And since we were talking about interest rates, I'm going to say that they're probably anywhere from 10 to 13%, but they're smaller amounts. CLTV, combined loan to value for a HE loan on a rental would be 85% is what we have access to. So as quick math, guys, if you have a value of a home of 100,000 and you owe on your first mortgage 50,000, the CLTV would be 85% of 100. So 85,000 minus the 50,000 first, which stays in place, you'd have access to about 35,000 in that example. And that would be access to rental properties that you just do not want to mess with that first lien mortgage. Different for owner occupied, and I'll take your cue on when you want me to get into that.
All right. Yeah. Okay. So we were just talking about income property second mortgages there. Tell us about primary residences.
Yeah. So primary and secondary should be in the same bucket. You can leverage to 90% CLTV, same math as before, but up to 90%. And these are going to be, you have HELOC and HE loan. I'm going to assume most people are going to go for the HELOC, right? The open-ended revolving is definitely more attractive than a closed-ended fixed, I believe, in a second lien. And prime is at 8, I believe, right now. Gosh, I should have checked before we got on, but I think prime is sitting, it's an index, an indice. Like the Fed fund rate, that's an index too. Prime is at about 8. And then depending on the characteristics, those LLPAs that I mentioned, loan level price adjustments, are going to come up with a margin. Maybe it's 2% over prime or 1 or whatever it is, depending on those things. So I would anticipate a HELOC and second lien position on a primary residence will be anywhere from 8 to maybe 10% more often than not is what you should expect. Interest only, open-ended.
All right. And on these second mortgages, whether that takes the form of a HELOC or a HE loan, how long is the initial fixed rate period typically?
So the HELOC is not fixed ever. Well, that's not true. There are hybrids where you can fix in for a year or 3 years, et cetera. Those are available. I'm not sure that you want to do that in a high rate environment. You probably want to avoid any fixed rate right now. If you had the option to get into it a couple of years ago, you're looking really good right now because you fixed in at some ridiculously low rate for a period of 2, 3, maybe 5 years. So I would tell people listening, fixing in on a HELOC right now is not going to be your advantage when we believe that rates are going to start coming down over the next year, et cetera. But for the HE loan, it's fixed for 30 years, just like a 30-year fixed first lien mortgage. It's fixed. You have it for 30 years. It's amortized. It's closed-ended. You're making your regular payments until you pay it off after the 30-year period of time.
We're talking about how you can more efficiently borrow in this environment where people and investors have high equity positions, and we have hopefully come off the mortgage rate highs from late last year. You're listening to Get Rich Education. Our guest is Ridge Lending Group President Caeli Ridge.
I'm looking at this all day, every day, Keith, and even 3% rates, 2.99% rates, 2.75% rates for the right individual because of the way it works. And you have that cool simulator. Maybe I'll just quickly tell people to go play with the simulator. The math will not lie to them. If they're putting in the accurate information, I'm showing that the all-in-one for the right person beats a 2.5% interest rate. That arbitrage and velocity of money, it just does. So I constantly trying to get people to move away from the psychology of our 2.5% interest rate. I know it was amazing and wonderful, but if the all-in-one can save you 50,000, 100,000 plus in interest and give you a line of credit for 30 years, you got to get away from that. People have to look at the math.
Caeli, one product you have there that's really flexible and has helped out so many people and helped save borrowers tens of thousands of dollars in interest or more is what's called your all-in-one loan. Tell us about it.
So this is a first lien HELOC, everyone. I'm such a big fan. I don't know that for the right individual, it's not for everybody, but for the right individual, I don't know that there is a loan product to rival it. It's got all the flexibility in the world. And as Keith said, the mechanics of this and the concept of this arbitrage, it's called velocity banking, infinity banking. If anybody's familiar with those terms, that's what this does. It allows you all the open flexibility to sort of become your own bank, where you have this line of credit. It is a first lien line of credit. So let's take a step back and talk about those low interest rates that everybody has secured over the last couple of years. We were very lucky to have 2.5%, 3% interest rates. And I'm constantly having this conversation, and I'm really trying hard to dispel the psychology of you can never do better than that, when it's just not the truth. And mathematically, you will be able to figure this out. I'm going to plug our website here. There is an interactive simulator that will take you to the all-in-one simulator, where you can compare your existing fixed first lien mortgage to the all-in-one. If the input data is very, very simple, no vials of blood here, guys. But if the input is accurate, the results page will tell you very clearly if the all-in-one will save interest and trump over the 30-year fixed at 2.5 or whatever it is, or if your fixed rate mortgage is more to your advantage. It will be very clear. There'll be no mistaking it. From that, I think further conversations will be necessary for those that see some real value in the all-in-one. I won't, go too far down that rabbit hole. It's a little bit more complicated than we probably have time for here. But the first lien all-in-one is such a fantastic tool. I really encourage your listeners to go ahead and check out, at the very least, the simulator and see how it applies to you.
The all-in-one loan operates much like a first lien HELOC. I don't think we have time to describe it all. Like you said, you do have the simulator there on your website at ridgelendinggroup.com, where one could see if their existing mortgage compares favorably or unfavorably to the all-in-one loan. But as we know, with a first lien HELOC, therefore, one feature of the all-in-one loan is the option, not obligation, but option of making interest-only payments to keep your payment down.
Yeah. And this is where it gets a little bit tricky for some people when we start talking about payments. So first lien open-ended HELOC, where it's called the all-in-one because you're replacing not only your mortgage with this revolving open-ended HELOC, but also a checking and savings account, and combining those two elements, whereby simple depository income is being used at dollar for dollar, driving down principal balance to save in daily interest accrual. I'm going to give a quick example, and then we can move on. And I encourage everybody to do the simulator. Email us. Let's talk through it. We'll take you by the hand. The learning curve's a little intense. It was even for me. But here's an example of velocity of money, okay? And kind of how the all-in-one works. So take a 30-year fixed mortgage and a 15-year fixed mortgage, okay? Both of them started at $400,000 each. You lock the 30-year at 4%. And the 15-year was locked at 7%. Without exception, everybody runs to the 30-year at 4%. I would have done the same if I didn't know the math. When in fact, the reality is that you will pay more, $40,000 more on that 4% 30-year than you would on the 7% 15-year, because the amount of time that you're paying on that mortgage is greatly reduced. And that's, I guess, an easy concept. It's the first step of trying to define this for most people. They can kind of see it in those terms because they understand the amortized mortgage. It's the amount of time that you are paying interest. So if you're utilizing your depository, checking, savings, and your mortgage, and all of that money is going in there month after month before it's going back out the door for whatever your living expenses are, and then whatever's left over stays in there 24/7 access. Nothing changes about your current banking techniques or strategies. It's all the same, but now you're in control. You've become your own bank. It's amazing. I can't say enough about it.
Talking about the all-in-one loan there. You sure can learn more from Ridge on that. Well, Caeli, is there really like anything else that I guess is noteworthy specifically in helping a borrower qualify for income property loans? Maybe a common problem or a borrower hurdle that you see in there at Ridge?
I would just boil it down to education, just lack of information. It's not dear Google stuff. The guidelines and what's available, all of these things are changing on a consistent basis, that real-time information is not available to them. So if I had to pick one thing, I would just say education. And I'm very proud to say that we really focus on that. If there's a value add about Ridge, I think there's quite a few, but the one that I think sticks out for most people is the education that we provide to our investors, and shining a light and giving them a look under the hood and what they need to know, teaching them how to optimize their qualifications and all of the stuff that we've been talking about here today.
Well, that's a good point because when we talk about real estate investing, you're really there in one of the more dynamic and fast changing parts of the industry, as opposed to something like home construction, where a lot of the methods haven't changed for 50 or more years, if you will. So, yeah, it's really staying up and staying informed on that and engaging with a lot of the educational resources increasingly that Ridge has for you to help you stay on top of that as an income property borrower yourself. And Caeli can tell us a bit more about that shortly. But why don't you tell us about all of the loan types, the mortgage products, if you will, that you offer in there?
Yeah, I think that's another great value add about us. We have a very diverse menu, if you will, of loan products that don't just start and stop with the conventional. We're not a one size fits all. So we've got the Fannie Freddies. We talk about that a lot. Our all-in-one, my favorite. We have a very diverse non-QM product line, and for those that aren't familiar with that term, QM stands for qualified mortgage. Fannie Mae and Freddie Mac are the epitome, the definition of what a qualified mortgage is. There's a whole definition we don't need to go into today. But so everything outside of that of that QM is now non-QM. And within non-QM, like I said, extremely diverse. There's things called the debt service coverage ratio product, where we're not showing borrower income, we're just looking at the property's income offset by the new mortgage payment. There's bank statement products. If you can't show tax returns, we're going to take deposits and average them. Asset depletion, if you've got a large self-directed IRA, we can come up with an income calculation for that. The list goes on. We've got commercial products for commercial properties, but also for residential properties, cross collateralization. Like I said, it's pretty diverse. We have, I think, a lot for everybody.
Well, you excel in there. You've been such industry leaders at originating income property loans for investors. What proportion of your business is income property loans and what proportion is primary residence loans?
Yeah, well, a lot of people don't realize we can do both, and we do both very well. But I would say that it's probably 70-30 non-owner occupied to owner occupied. A large part of what we do is the investor loans, but most of our investor clients come to us for their primary needs too, because we already have their life on file and can get that done very competitively too.
Right. And you keep growing. You're in almost all 50 states now.
I know. Can you believe it? We're in 47 states. We're not in North Dakota, New York, or Vermont. Otherwise, we're everywhere.
Well, let our audience know how they can learn about your resources.
Yeah, so there's a couple ways to find us. Our website, ridgelendinggroup.com. They can email us, info@ridgelendinggroup.com. Our toll free is 855-74-RIDGE, 855-747-4343. And while you're on our website, gang, check us out on our community. I have a live event every Tuesday, 1:30 Pacific, 4:30 Eastern. Lots of good information. Register and it's free. Lots of good information and education like we've been talking about here. Hope to see you.
Oh, it's been a terrific and crucial mortgage market update. Caeli Ridge, thanks so much for coming back onto
Thanks,
the
Keith.
show.
Appreciate it.